showcased once again its robustness and prompted traders to reassess their scenario for a less hawkish Fed going forward. In this report, we aim to shed light on the catalyst driving the precious metals price, assess the future outlook, and conclude with a technical analysis. Last week, the Federal Open Market Committee voted and delivered a 25 basis point rate hike in line with broader expectations, lifting the key policy rate at 4.75%, and according to the December dot plot, the central bank is now just shy of a 50 basis point away from the terminal rate of 5.25%. In its accompanying statement, the bank once again highlighted its resolve at further tightening its monetary policy stance in order to achieve sufficiently restrictive levels, which aims to contain raw inflationary pressures from becoming deeply entrenched within the US economy. Even though the stance adopted by the Fed was clearly hawkish, the market's reaction to the decision was unequivocally dovish, exacerbating the divergence between what the Fed communicates and what the market interprets, apparent since the start of the year. This leads us to believe that the market places more weight on incoming data in its assessment, rather than taking the Fed's guidance for granted. The view for a less hawkish approach from the market could be predicted upon the better-than-expected growth results in the past quarter alongside the latest data on the inflationary front, indicating that inflationary pressures have eased further from the peak, igniting optimism that the US economy may avert a recession or at the very least experience mild recession symptoms. Therefore, market participants held on their bias and decided to fight the Fed's explicit comments that signaled more must be done to contain inflation. Hence, the dovish interpretation kept the dollar suppressed and allowed gold to climb to higher ground, peaking around the $1950 level after the decision. Market participants, however, were forced to alter their assessments after a blowout employment report on Friday, which showcased once again that the labor market remains robust, albeit a high interest rate environment. More specifically, non-farm payrolls unexpectedly rose to 517K in the month of January, obliterating forecasts for a slowdown to 185K. Equally, the average hourly earnings rose to 4.4%, beating estimates of 4.3%, while the unemployment rate fell to 5 decades lows, being reported to 3.4%, below expectation for a rise to 3.6%. The results practically reaffirmed the Fed's view that interest rates will stay higher for longer, as job growth accelerated sharply in January and broadcasted that the employment market is yet to show any cracks. As a result, the pressures fell sharply from its 9-month highs as the dollar gained traction. Moreover, the better-than-expected ISM non-manufacturing PMI figure, which rebounded from contraction territory in January and returned to growth, provided extra support for the dollar and aggravated gold's fall. Also, the benchmark 10-year Treasury yield rose from its temporary fall to the 3.4% level after the dovish Fed decision and reclaimed the 3.6% level after the stellar employment report, nudging investors to reassess their prospects for a Fed pivot in the second half of the year. Lastly, we would like to note Fed Chair Powell's speech later today, and it would be interesting to see whether he would press on with his hawkish narrative. Should that be the case, we may see some support for the dollar and gold relenting more ground. Thank you for watching.